Good morning, everyone. 7:15. We'll get rolling. As usual, if anyone has questions, please feel free to ask. If you want to email me questions, you can also do that. Today we are going to cover corn a little bit more in depth. We did wheat a couple weeks ago, so thought we'd stay on that and kind of dive into each commodity. So this week we'll do corn. But if you do have questions on other commodities, please feel free to ask at any time. So we'll start off with CFTC report. I think this was noticed, the big move in corn futures after the crop report. We got the fund selling nearly 65,000 contracts short. The one thing to note, though, was the pricing or the producer merchant side covering futures for end users. Looked like they took a lot of that sell off as an opportunity to price some grain, at least here in the short run, against March futures. So, good opportunity to price any unpriced sales that were on the books. The other commodities, beans had another big sell off week, getting closer to even. And we still have the big discrepancy between Chicago and Kansas City wheats. More covering on the short side for KC, getting closer to even. And then we have soft wheat still short over 100,000 contracts on the managed money side. So that's pointing towards a quality spread. If the world needs quality, they'll come for hard wheat. And then we'll have to see if the world actually does need to come there. But if they do need to, it's at a pretty big premium to the rest of the world right now. Just another look at the effect of price in the managed fund positions. We see it in the day-to-day trade when we have big moves in managed money, really can dictate the short-term price direction. So we'll continue to watch this as we go forward. But with the funds covering KC and getting closer to even, if we have another big crop to come, there will be plenty of room for them to sell that hard wheat contract if they feel obliged. So export sales pace, I think, when we sit here and look at the overall S&Ds, the pace is one of the indicators along with inspection pace. But I wanted to look at comparison week on week. I guess 2 weeks here, but one of the big ones, you start looking at the pace for corn. We were 6% above 2 weeks ago, 5% now. Hard wheat hasn't changed, but we've really seen that sales pace drop off, and we'll look at that here in a minute. So export sales for soybeans, with the Chinese demand, it looks like they will eventually buy the 12 million tons that they promised to buy here. That's been the big support in, the week-on-week sales that you can see in the top right when they've shown up and bought cargoes out of the U.S. As it looks right now, they're buying cargoes through March and April, and that should be pretty much the end of the window they're going to buy if South America starts coming online here in February. So the demand for U.S. beans at a premium to South America should stop this U.S. export program to China, especially if they do hit their quota that they said they were going to reach. We did have a reduction in USDA export sales for soybeans. That indicated that we're overpriced. We are doing the business to China, but we have lost out in some of the other destinations that we were doing previously. Hard wheat sales have gone flat. So hard wheat is a premium to the rest of the world. The last 2 weeks have actually been negative sales. We've seen cancellations. And outside of CCC business out of the Texas Gulf, we haven't really seen any new demand. Part of that being, we're $15 to $20 premium fob to fob against other origins in the world. And the U.S. Texas Gulf is getting near capacity with the Milo program that we are seeing to China right now. And when we start looking at Milo sales, we've had a pretty good run here of Milo sales, mainly to China has come into the market. It's starting to make the 225 million bushel export number that USDA has look a little bit more reasonable. We're using 200 million for now, and it looks like this program now is continuing out into possibly April and May before we get into South Texas harvest. But everything looks like that program should continue to move forward as long as prices stay competitive in China. So let's get into corn. The first thing we'll look at, world corn conditions. I mean, everything overall looks pretty good right now. I mean, there's a few spots to watch out for. There is some dryness in eastern Brazil to watch out for over the long run. But for now, I mean, there is really no major concerns in the major crop producing areas. The corn timeline, just wanted to kind of show the planting phases that'll be coming up here. We're already into the first crop of Brazil, and we'll start planting the second crop here over the next month or two. And same thing for Argentina. And then, we get into our typical planting period here in the Northern Hemisphere come March and April. So let's take a look at the world corn kind of S&Ds. Total carry out to use, I mean, is very comfortable. We're, not near record highs, but we are more comfortable than we have been in previous years like 2020 and 2023. Most of that is made up in the United States. I mean, you can look on the right and see the United States production increase, and the ending stocks is mainly in the U.S. side of the balance sheet. So that's why we've seen some of the export demand and, the push here for U.S. exports and a place for U.S. corn to go. So export sales for corn continue to be extremely strong. We've had a few down weeks here in the short run, but the U.S. will be the market at least into the early summer months. And then depending on price versus South America, we could see an extended period here. But when we're looking at U.S. corn exports, some of the other years that had a similar total export program had big Chinese demand pictures in there. We don't have China in for corn this year, but we have picked it up in other markets. And we've seen good continued demand out of both Mexico and Japan. So at this point, we're on pace to hit USDA's export sales numbers. So, we need to stay competitive throughout the spring, and that'll get into some of the long-term price talk that we discuss here later in the call. One thing that has come up is the Iran tariff. Anyone doing business with Iran could be subject to additional tariffs. We'll have to see how that plays out here, but wanted to take a look and see, from the U.S. side, we haven't done anything with Iran in years. So it isn't a direct impact on the U.S., but it could be an impact on South America and what they decide to do, because they are a big portion of what gets shipped into Iran. And will that displace that grain into some other destinations that U.S. grains go to? So on the domestic use side, USDA has a record domestic use here. We've seen extremely good ethanol margins, so no surprise to see continued increases in ethanol production. But I think the biggest surprise is still this feed and residual number at a record high here over the last 15 years. And when we look into, 750 million bushels higher than last year with either an unchanged or a down cattle on feed number, I think this is one of the topics that people are still discussing. Can we really hit a record domestic use number for corn if the demand isn't there? And are they overstating feed to offsets an increased balance sheet? So as we move later in this marketing year and get more WASDE reports in front of us, we'll have to see if they adjust those numbers. They did amend it higher last month. So I think it's one of the topics that most people think could increase this carry out or be an offset if they do make some changes further down the road on production or stocks. So wanted to get into some of the regional side here. The plains corn production, if you start kind of looking from Colorado, Nebraska down to Texas, I mean, we had a big increase year on year and one of the largest productions for that region that we've had since 2000. So no surprise there. We've all seen how much corn is in our area. But as we start looking at stocks, for Kansas, Nebraska, and Colorado, we're up year on year, pretty sizable increase. So the regional stocks, especially when you look at Kansas, I mean, we have plenty of corn. We will have plenty of corn as we move forward. And Nebraska is very similar. We have plenty of corn in this area. So what is that going to do to corn basis? I mean, we've seen corn basis. So looking more at the right slide here, corn basis has been weak. Seasonally, we would normally get a pop in basis during this time frame, but it looks like we should stay steady to flat as we move forward. And really no reason to expect anything drastically changing unless we do have some kind of crop issue as we move forward. But the slide on the left is CIF. That is, basically being driven by the export demand that we've seen. Don't expect that to really drop off at any point here. It should stay strong as long as we have continued export demand. So on the balance sheet side, wanted to start looking at how this could affect price. So borrowed ATI's balance sheet for 25-26 and their rough outlook for 26-27. So if we take a 15% stocks to use ratio for corn for next year, which, they're using 94.5 million acres and a down yield at 183 compared to this year, we still have a 2.4 to 2.5 carry out in corn. And that would indicate definitely below a $4 corn price. So, actually it points to more like a 340 if you look at the right side of the screen here. So the bigger carries the bigger carry out has driven the carries wider. The last few years we have seen both the March D's and July D's firm up during this time of year, mainly being driven on tight carryouts in the east, driving that spread market. We're not seeing that this year. The 2.4, 2.5 carryout has really collapsed the spread markets, should be able to carry corn forward as we move along. And if we have another good crop next year, should anticipate longer term carries. So no reason to really rush or panic to sell corn, if they do have carries, but that will keep probably CIF values steady to firm. I don't think it really has a big effect on our basis market with the amount of corn available, but more of a driver in the CIF market. So wanted to look at ending stocks versus price, did the same thing, outlook on wheat, a carry out of 2.2 to 2.5 has put prices sub $4 sometime during the new crop harvest time. So today we're sitting new crop corn at 448.5. And, if we have a decent corn crop, we were probably looking at trading sub $4 corn. Not that it will be long term, but, this market has found a way to trade sub $4 the last 2 years. So if guys want to get something on the books, this is a good thing to point out that if we have a 2 billion bushel plus carry out, it probably means you trade sub $4 at some point during the marketing year. The seasonals, when we have looked at the best times to sell corn, historically it's during the weather markets here, April to July. I mean, you can see it in both the 5-year chart and the last couple of years. If we are going to get a rally, it's early on, whether it's planted acreage, planting concerns, or the general weather markets that come into play. As you get into August, those are some of your worst times to sell. So if these guys, want to get something on the books, it's better to start looking at that and having price ideas here earlier in the marketing year than waiting closer to harvest. So a corn price outlook, we had that big sell-off that broke us out of that trading range between 435 and 450. It probably puts us in a new range of 420 to 435, 440. But I think anytime you get a rally above 435 here, you need to take a hard look at selling some of your old crop corn. And D's 26 futures, we're close to 450. I think if you have an outlook that you're going to have corn for next year, I think you need to take a look at start marketing somewhere in this 440 to 455 range, and make sure that you avoid sub $4 corn when we get to harvest. Wheat price outlook, we didn't see the sell-off as big in wheat. We've kind of ground here in between 520 and 550 for the last 4 months. I don't really see anything major changing there. We are the last residual supplier for quality in the world, so we're not competitive today, but the downside probably is 5 to 510. And then same thing, if you see a rally above 535, you need to take a hard look at marketing into those rallies when they show themselves. 26, 27, same kind of thing. These carry markets are giving you an opportunity to sell deferred cash. So take a hard look at it out there. As we move forward and roll to each new expiration, if we have good world crops, we're going to find a way to grind to the most recent low in the front month. So selling the carries is your best opportunity today. And if you sell $6 wheat for 26 or 27, it's probably not your worst sale that you can put on, at least here in the short run. So that's what I have for today. Is there any questions out there? Comments?